As I'm sure you know by now, the Federal Reserve just met, and there's already a ton of over-sensationalized BS on the subject. So what I want to do is just give you the facts so you know exactly what's going on in one video, and then I'll give you my opinions on what I believe this means for you and me, so let's do just that. As always, my name is Derek, and I got my degree in finance, so you don't have to. Let's go over the facts. So, first and foremost, the Fed will not raise interest rates currently. I think that this was expected, and it did remain true. The federal funds rate is currently at 5.5%, and it will remain that way. Now, the real question is, if the fight against inflation is not over, why do they not raise rates just to make sure that inflation comes down? We'll touch on that in a second. First and foremost, I want to cover the fact that this does not, by any means, mean that the Federal Reserve is done raising rates or is about to cut rates. The chairman, Jerome Powell, made this very clear. The fight against inflation is not over, and this pause does not mean that there may not be future rate hikes, again, either late this year or into the next year. The next thing that was made very clear, both by the chairman at the conference and just by looking at the data, is that inflation is still too high. And in my opinion, inflation is looking more and more sticky in the 3% range. Sticky meaning that regardless of interest rate increases, it is sticking and not moving. That is a problem for the Fed, and it is one of the reasons why the Fed is not ready to cut rates just yet. Now, there are a lot of angry people that are actually kind of upset at the Federal Reserve for not cutting rates. And those are usually people, CEOs, employees, and industries that are heavily affected by interest rates. So think auto loans, think mortgages, think refinances, think realtors. These people whose businesses are directly tied to interest rates right now are getting screwed, basically, because of high interest rates. So much so that some of these people actually wrote an open letter to the Federal Reserve, basically, I don't want to say begging, but basically begging them to stop raising rates and to lower rates. Now, of course, Jerome Powell cannot make that promise because Jerome Powell does not know if the fight against inflation is over. Until we see inflation data continually go down, the fight against inflation is not over. And that data is not coming in. Right now, we do see an improvement in inflation, especially when compared to a year ago. But inflation is looking sticky currently. Okay, so let's answer that question. If the fight against inflation is not over, why did the Federal Reserve not raise rates? Well, one of the main reasons has to do with Treasury bonds and government bond yields. So, right now, government bond yields are very, very high. The reason they're high is probably because of interest rates being high anyways. But the fact of the matter is when Treasury yields are high, it basically raises the long-term interest rate anyway. So again, Jerome Powell did touch on this, but just looking at the data, the fact of the matter is there is less work that has to be laid upon the federal funds rate when Treasury yields are high. When Treasury yields are high, it takes burden off of the federal funds rate and accomplishes the same thing, which is what? More expensive capital. That is what the Federal Reserve wants, is more expensive capital. When it is more expensive to borrow money, business activity shrinks. So, with that said, while there is less work on the federal funds rate, there is also a bloodbath in the bond market currently, and it has been for the last year or so. Why? Remember, bonds and yields are inversely correlated. So, high yield, low bond price. Low yield, high bond price on existing bonds. So, when you have existing bonds and interest rates shoot up and yields follow, the payout does not change. So what changes? The bond price. Because if you are paying out the same, but it has to be a higher percentage of the bond prices come down. That's why you've had a bloodbath in the bond market for quite some time. Okay, he did make it clear that he also wants to make sure that the bond yields are rising naturally. He said this, that are rising naturally and not that they are rising on the expectation of him raising rates, whatever that means. Because yes, 100% the bond market is reacting to interest rates. They are correlated. Okay, expectations. Okay, now let's go over some expectations. So those are the facts. That's basically what's happening. What I'm going to do is go over some expectations on analysts in regards to interest rates, and then I'll give you my opinion on what all this means. So expectations right now are rate cuts will not begin until quarter 2, quarter 3 of 2024. So basically almost a full year away. And in my opinion, I could very much see that. I think that is going to be some time before we get any significant rate cuts. Remember, just because the Federal Reserve stops raising interest rates, that does not mean that all of a sudden tomorrow that it's going to be roses and sunflowers. Rates are going to remain high for quite some time. So much so that even when rates begin, there is an expectation that rates will most likely not fall below 4% until and that's on the federal funds rate, until 2025. We're in 2023, 2024, and then 2025. That means that we're going to remain in a high interest rate environment for much longer than expected, which means that mortgages are going to remain high for much longer than expected, and same with credit cards, and same with auto loans, and same with everything. The problem is that this economy currently seems to have been built on the back of very inexpensive capital. Some of the people who are going to watch this video are going to say, hey, back in the 80s, interest rates were crazy. That is very true. But the current economic cycle has been built on low interest rates. This means that businesses are struggling, and a lot of businesses were built on the back of these low interest rates, which means that when you change that all of a sudden, these business models suffer because they're so accustomed to cheap injection of capital. When that cheap capital goes away, these businesses struggle. I understand that in the 80s and in our history, there have been much higher interest rates. But remember, the economy grows in cycles, and this current cycle has been built on very, very cheap interest rates. So a lot of businesses are suffering right now. And that's why a lot of people are going to say, well, look at corporate greed. I mean, prices are through the roof. Yes, absolutely. But then look at corporate profits. Those have been falling steadily for about a year. Okay, now, in my opinion, this is kind of a catch-22, really. On one side, you have high interest rates and kind of high prices. So you have high interest rates and high inflation. On the flip side, you have runaway or rampant inflation. And the Federal Reserve is kind of put, what they say, between a rock and a hard place, or out of the frying pan into the fire. Basically, they have a choice to make, and that is, do you lower interest rates too soon and you cause runaway inflation, which is very, very dangerous for the economy, or do you keep rates high, which basically hurts everybody in one sense or another, businesses, employees, etc., but you have a chance at fully controlling inflation. And that's basically what the Fed is trying to make up their mind with. And when we look at data, they're almost always going to pick the fight against inflation. With that said, the Federal Reserve kind of is the people who caused this inflation in the first place. You have quantitative easing that took place in 2020. You had government borrowing and basically stimulus checks. All that injected capital and created a crazy, crazy inflation environment. So the Fed kind of caused this, and it's kind of trying to solve it. And of course, the Fed's not going to tell you that, but that's the fact of the matter. Now, we can argue all day long if those policies in 2020 were necessary. I'm not here to argue that. That can be a different video. The point is, that's what happened. This is the problem that was caused. And on top of that, there's a strongly backed theory that the Federal Reserve probably waited a little bit too late to raise interest rates in the first place, and now they're trying to play catch up, which is why interest rates have gone up so fast in such a short amount of time. Basically, in our history, don't quote me on this, but basically the fastest increase in interest rates in like the last 50 years. So, what does this mean to me, and what are my opinions? Well, one, I do think that at least one more interest rate hike is highly plausible. And this is based on current inflation data. Inflation looks very sticky, and it looks like it's getting sticky in the 3%, so I could see the Fed raising it at least one more time. The fact of the matter is, it doesn't really matter what I think. It doesn't matter if they raise rates again or not, whether it's 5.5% or 5.75% on the federal funds rate. You and I are going to be stuck in a high interest rate environment for quite some time. Also, remember that the fight against inflation does not, by any means, mean deflation. Okay? What it means is a slowing down in the increase of prices of goods. So that means that these things that cost, let's say you're buying a car, right? And a car back 5 years ago cost $30,000 and now it costs $40,000. Once inflation comes down, it doesn't mean that car is going to go back to $30,000. It's going to the prices we have are basically, we're stuck with those prices because the Federal Reserve also does not want deflation. Now, in little pockets here and there of the economy, you might see deflation, but over the whole economy, slowing of inflation does not mean prices returning back to 2021 or 2020 levels. That's most likely not going to happen. Now, again, doesn't matter if I'm wrong or right in regards to the interest rate hike. We're stuck in a high interest rate environment for longer. So, all in all, I hope this video was helpful. I know that there's a ton of sensationalized BS out there, and people I'm trying my absolute best to not have clickbait here. I just want to provide you with data, and I want to give you my opinions based on my decade in this industry and based on my degree in finance. That's it. You can make inferences, we can have discussions, and like I always say, I do not have a chip on my shoulder. I do not in any way think I'm the smartest person in the room. And just like I want to share my experiences, I want to learn something from you. So if you have a different opinion, please feel free to leave that in the comments. Just be civil and let's have discussions and debates, because differing of opinions is what makes people come to the correct conclusion. All right. So I can learn something from you just like you can learn from me. With that said, it's very difficult to shine when you're trying not to use clickbait. So if you like this type of content, please consider subscribing. It helps the channel tremendously. This is a relatively new YouTube channel, and it's something that I'm passionate about and I want to continue to do for quite some time. And if you haven't already, please turn on the bell notification. We release new videos every Tuesday. Sometimes I'll release a video on Wednesday, Thursday, Friday, or Saturday, like today, because something needs to be talked about. Other than that, I hope you had a great week, and I hope you have a great weekend, and I will see you in the next video. Take care.